Stop. Right now, pull out your phone. Open your banking app. Look at that number sitting in your checking or savings account. Maybe it represents 40 years of hard labor. Maybe it is the sale of a family home. Maybe it is just the safety net that lets you sleep at night. You look at that number and you see my money. You are wrong. In the eyes of the law, in the eyes of the bankruptcy courts, and in the fine print of the user agreement you scrolled past and clicked accept on years ago, that number does not represent your property. The moment you handed that cash to the teller, or the moment that direct deposit hit the ledger, the legal title of that money transferred instantly from you to the bank. You are not a depositor. You are an unsecured creditor. And the bank, they are a borrower who has taken your money and leveraged it 10, 20, or 50 times over in the global derivatives casino. We all remember 2008. We remember the anger. We remember the government stepping in to use taxpayer money to bail out the banks that caused the crash. We were told, never again. We were told the system was fixed. They lied. They did not fix the system. They weaponized it. While you were distracted by political theater and mainstream media noise, the laws were rewritten in the dark. The era of the bailout is over. We have now entered the era of the bail-in. And when the next crisis hits, and the cracks are already forming in the commercial real estate sector as we speak, the government is not coming to save the banks. You are. Your savings are no longer just savings. They are the emergency equity buffer for a system that is mathematically destined to fail. Where are you watching from today? Are you in the United States, the UK, Europe, or Canada? Put it in the comments, because I guarantee you the laws I am about to expose have been passed in your jurisdiction, and you probably did not even hear about it on the evening news.
To understand the theft that is coming, we have to look at the test run. We have to look at the crime scene. Cyprus 16th, 2013. It was a quiet Saturday morning, the kind of morning where retirees head to the cafe and business owners tally their weekly receipts. The banks were closed for the weekend. Suddenly, electronic transfers froze. ATM screens went black, were displayed out of order. Panic did not set in immediately. People thought it was a glitch. But by Sunday, the news broke. The European Union and the IMF had decided that the Cypriot banks, which had gambled away their liquidity, needed to be recapitalized. But they were not going to print new money to do it. They were going to take it from the accounts of the people. On Monday morning, the banks did not open. They stayed closed for nearly 2 weeks. When the doors finally cracked open, the world had changed. Anyone with deposits over a certain threshold saw 47.5% of their money vanish, gone. Not stolen by hackers in a basement in Eastern Europe, but stolen by men in suits in Brussels and Nicosia. In exchange for their hard-earned cash, these depositors were given equity in the bank. They were given worthless stock in a failing institution. They went to sleep on Friday, thinking their money was safe in a vault. They woke up on Monday as involuntary shareholders in a bankrupt casino. Sound familiar? It should, because the mainstream media told you Cyprus was a one-off. They told you it was a unique situation involving Russian oligarchs and money laundering. They told you It cannot happen here. But that was the distraction. While the world pointed and laughed at Cyprus, the architects of the global financial system, the Financial Stability Board, operating out of Switzerland, were taking notes. They were not horrified by Cyprus. They were inspired by it. Cyprus was not a tragedy. It was a template. Within 18 months of the Cyprus confiscation, the G20 leaders met in Brisbane, Australia. There, without fanfare, without a public vote, and without a single headline on CNN or Fox News, they ratified a new global standard for banking resolution. It effectively declared that in future financial crises, taxpayers would not be on the hook. Great, you might say, let the banks fail. But that is not what the document said. It said that bail-ins would be the primary mechanism for resolving insolvency. It reclassified your customer deposits as part of the bank's capital structure. Sound familiar? It is the exact same mechanism used in Cyprus, but now it was codified into international law. This is not a conspiracy theory. This is the Dodd-Frank Act in the United States. This is the Bank Recovery and Resolution Directive in the European Union. This is the financial bail-in regime in Canada. They changed the definition of solvency. Imagine you lend your car to a friend. He drives it recklessly, crashes it, and totals it. In a sane world, he owes you a car. In the bail-in world, the law now says that because he crashed the car is now his, and you are now a shareholder in his bad driving habits. This is the reality of the banking system today. Sound familiar? It is exactly what they did with the gold confiscation in 1933. They changed the rules when the game was about to end. But the receipt is wilder than you think, because there is a hierarchy of theft, and you need to understand where you stand in line. Most people believe the hierarchy of a bank goes like this. The bank fails. First, the shareholders lose their money, then the bondholders, then the bank sells its assets, and if there's anything left, or if the government steps in, the depositors get paid. That's the fairy tale. Here's the reality of the bail-in mechanics, specifically under Title II of the Dodd-Frank Act and the bankruptcy reforms of 2005. The modern bank is not a vault. It's a hedge fund that offers checking accounts on the side. The biggest banks in the world, J.P. Morgan, Deutsche Bank, HSBC, hold trillions of dollars in derivatives. These are bets on interest rates, bets on currency fluctuations, bets on the price of oil. The total notional value of these derivatives globally is estimated at over $1 quadrillion. That's 10 times the GDP of the entire planet.
Now here is the secret mechanism that destroys your wealth. In the event of a banking collapse, derivative counterparties have what is called super priority status. This means that before the bank creates a bail-in plan, before they look at the shareholders, and long before they even think about the depositors, they must settle their derivative books. The casino debts get paid first. If a major bank goes insolvent, the law allows them to take the collateral, your deposits, and use them to pay off the winning bets of other banks and hedge funds. You are not just an unsecured creditor. You are last in line. You are standing behind the shareholders, the bondholders, and the massive derivative monster that eats liquidity for breakfast. Let us look at the numbers, because math does not lie, even if politicians do. The FDIC,
the Federal Deposit Insurance Corporation. This is the shield that every American points to when I talk about bail-ins. But I'm insured up to $250,000, they say. The government backs it. Let us look at the balance sheet of the FDIC. As of the last reporting period, the FDIC Deposit Insurance Fund holds roughly 1.25% of the total insured deposits in the United States. 1.25%. That means for every $100 you have in the bank, the insurance company has $1.25 to cover it. This is not insurance. This is a confidence trick. It works perfectly fine if one small regional bank fails in Oklahoma. The FDIC steps in, prints a check, and everyone stays calm. But what happens in a systemic crisis? What happens if a global systemically important bank goes down? What happens if the derivative bubble pops, which is currently holding $230 trillion in exposure at just a handful of top U.S. banks? 1.25% is gone in seconds. The FDIC does not have the money. The government implies they will back it, but legally, the FDIC is an independent agency. And even if the Federal Reserve steps in to print the difference, think about it. If they have to print $10 trillion overnight to cover the deposits, what is that money worth when you finally get it out of the ATM? Hyperinflation is just a bail-in by another name. Either they take 50% of your number, or they destroy 50% of your purchasing power. The result is the theft of your labor. Let us go deeper into the bad bank mechanism. Under the current resolution regimes in Europe and the US, when a bank enters the danger zone, the regulator has the power to split the institution into a good bank and a bad bank. The good bank keeps the essential services, the payment processing, the secured assets. The bad bank gets the toxic assets, the bad loans, the underwater commercial real estate bonds. And guess what else gets shifted to the bad bank? Your uninsured deposits. If you have a business account with payroll, or you just sold a house and have $500,000 sitting there for a week, that money is moved to the bad bank. The bad bank then goes through bankruptcy. Your money is converted into equity. You are given shares in the bad bank, but the bad bank owns nothing but toxic waste. Its shares are worth zero. This is how they legally wipe out the liabilities of the system. They do not erase the debt, they erase the creditor, and the creditor is you. We are seeing the precursors to this right now.
Look at the commercial real estate market. Offices are empty. Vacancy rates in major cities are hitting 20–30%. Who holds the loans on those empty towers? Regional banks. In 2023, we saw Silicon Valley Bank, Signature Bank, and First Republic collapse. The government stepped in and broke their own rules to bail them out because they were terrified of a panic. But they explicitly stated this was a systematic risk exception. Exception, meaning it was not the rule. They burned through a massive amount of political capital and emergency funds to plug that hole. They cannot do it again for the next wave. The next wave will be bigger. When the commercial real estate loans start defaulting en masse in 2025 and 2026, the regulators will have no choice but to trigger the bail-in clauses. They have built the legal cage, and now they are waiting for the beast to walk into it. Why do you think the central banks are pushing so hard for CBDCs, central bank digital currencies?
A bail-in is messy with physical cash. If people smell fear, they run to the ATM. They pull cash out of the system. A bank run can destroy a bank in hours. But with a CBDC, there are no ATMs. There is no physical cash to withdraw. If the system decides that a bail-in is necessary, they do not need to close the branch doors. They simply reprogram your money. They can code a negative interest rate, a polite term for confiscation, directly into your digital wallet. They can lock your funds to prevent capital flight. They can convert your liquid cash into a long-term government bond that matures in 10 years, whether you like it or not. The infrastructure for the bail-in is being finalized alongside the infrastructure for the CBDC. They are two sides of the same coin: control and confiscation. You need to understand the psychology of the freeze. In every historical instance of a bail-in or a currency confiscation, from Argentina in 2001 to Lebanon in 2020, it happens on a Friday night or a weekend. The government and the banks issue statements right up until the last second saying the system is strong, there is no risk, your money is safe. They have to lie. If they told you the truth, the collapse would happen instantly. In Lebanon, people were told the banks were fine. Then they were told they could only withdraw $100 a week. Then nothing. Their life savings were still there on the screen. The numbers had not changed, but the value was zero. They were trapped in a zombie banking system. This is the psychological trap. You believe the number on the screen is real. You believe the status quo will last forever because it has lasted for your entire life. But we are at the end of a long-term debt cycle. The global debt-to-GDP ratios are unsustainable. The interest payments on the U.S. national debt alone are now higher than the defense budget. There is no way out of this mathematical corner except through default or inflation. A bail-in is a structured default. It is the system deciding that the survival of the banking infrastructure is more important than the survival of your personal net worth. So, what happens when the next crisis triggers?
Day 1. Rumors swirl. A major bank fails to meet a margin call. Day 2. Stock markets dive. Bank stocks plummet. Day 3. Friday. The Fed announces an emergency holiday for the banking system to stabilize markets. Day 4. Saturday or Sunday. The bail-in mechanism is triggered. The good bank, bad bank split happens. Large depositors are notified that a portion of their funds has been swapped for equity to recapitalize the institution. Day 5, Monday. The banks open, but withdrawals are capped. Capital controls are in place. You have money, but you cannot move it. You cannot convert it. You cannot save it. This is not science fiction. This is the law. The G20 nations agreed to this. The FSB monitors it. The FDIC has written white papers on how to execute it. They call it Orderly Liquidation Authority. Orderly for them, catastrophic for you. We are staring down the barrel of 2026. Why 2026? Because that is when the massive wave of corporate debt and commercial real estate refinancing hits its peak. Trillions of dollars of debt written at 2% and 3% interest will need to be refinanced at 6%, 7%, or 8%.
Most of these businesses and buildings cannot afford that. They will default. The banks holding that paper will become insolvent, and when they look for capital to fill the hole, they will not look to the government because the government is broke. They will look at the deposit ledger. They will look at you. Denial is the most dangerous investment strategy in the world. Thinking they would not dare is exactly what the people of Cyprus thought. It is what the people of Lebanon thought. The mechanism is built. The switch is waiting to be flipped. Your savings account is not a vault. It is a crime scene waiting for a victim. If you are sitting in cash, fully exposed to the banking system, trusting an insurance fund that holds less than 2 pennies for every dollar it owes, you are walking blindfolded into a buzzsaw. You need to become your own central bank. You need assets that have no counterparty risk, assets that do not rely on the solvency of a 30-year-old banker in a high-rise. The bail-in is coming. The only question is, will your wealth be inside the system when the gates close, or will you have secured your exit? Subscribe to this channel. We do not peddle hope. We peddle the unfiltered truth that the financial media is paid to hide from you. The clock is ticking. Watch the next video to understand the 3 assets that are immune to a bank bail-in.